I'm David Bick. I'm the Florida tax guy, as you already know. I'm here to answer and hopefully inform you about taxes in your particular field. So I'm not one to do presentations and look at this and go back and spew information to you. Before all of you came, I asked you if you wanted to pick up your phone and text taxguy.quiz to 77948, and there you'll have like 4 or 5 questions you can answer, and you can really get a good feel of: are you at risk of an audit? Are you paying too much in taxes in your particular line of work? I saw a hand. Do you have a question? Anyone? No. Oh, it's taxguy.quiz to that phone number, or to that text SMS code, and hopefully that'll give you some information. So how many of you here are realtors? Realtors, right? That's how you pronounce it? Okay. How many of you here are business owners?
Everybody should keep their hand up.
Okay, I'm making sure, because at many of these presentations I go to, everyone raises their hands when they're realtors. When I ask business owners, most people don't. And the first thing you have to make sure that you understand is you're a business owner who happens to be in the business of real estate. It's not the other way around. That being said, most business owners, when they start their business, they choose a certain structure for the business that is most advantageous to them, from a legal point of view, as well as from an accounting point of view. That being said, how many here are PAs? Okay. And the ones who are not, you're operating, I'm assuming, as a sole proprietorship? Yeah. Okay. Very good. Well, let me go into a little detail. As you all know, this is pretty straightforward. You guys want commissions. That's what makes everything tick, right? Okay. Right. So unfortunately, you have a silent partner, and everybody knows who that is, and they want to put their hand in your pocket and share the commissions with you. That's the IRS. So the question you have to ask yourself is, how do you keep more of your earnings? And you know, there are other solutions, but the main solution is obviously you just want to share less tax, less income with them. Pay less tax. So are you paying too much in taxes? We're going to hopefully review that and find out now, and then I'll answer your questions regarding it. So the secret to paying less tax, I call, is something called a strategic IRS tax plan. I'm using their letters against them. IRS is an acronym, and it stands for incorporate, record keeping, and taking a salary. And I'm going to go into all these 3 components because they're all equally important. Incorporating, as a realtor, as I said before, you run and you own your own business. Choosing a correct business structure for your business is going to be crucial for you. It's going to affect how much you, in the long term, will pay in taxes to the IRS. Choosing the wrong business structure is going to end up costing you a lot, and I'll explain how. Second, record keeping, which I know is a pain in the butt, is vital. Any of you who have been through an audit know that creating a new mileage log or looking for receipts or trying to defend yourself against the IRS, if you don't have proper records, is going to be a nightmare. The IRS is the only entity that I'm aware of is that you're guilty until you can prove your innocence. Unfortunately, you know, there's no court of law. There's no going to them and saying, I'm innocent until you prove me guilty. It doesn't work that way. If you decide to incorporate it, which is, in my personal opinion, a wise choice based on your particulars, you need, and I can't stress this enough because I've seen it so many times where it becomes a problem, you need to take a salary. If you do not take a salary from your corporation, eventually you'll get flagged. The S corporation, what they call tax, and the IRS is aware of that. In fact, in 2016 is the first year I've seen it, they're actually asking on all the corporate tax returns, is the officer taking a salary? Which leads me to believe they're really starting to look and pin down this right now. So we discussed, incorporating, record keeping, and salary, and like SpongeBob. So how does that help you? Well, let's explain. By implementing an IRS or strategic tax plan, you're going to lower your taxes. You're definitely going to reduce your chance of an audit. You know how corporations, you protect your assets if, God forbid, you're sued in a lot of business. Record keeping will definitely keep you more organized. At the end of the day, you're going to keep more of your hard-earned money. when I've spoken to other realtors, they believe having a PA behind their name does provide credibility. I'm not sure if that's true or not, but so be it. Oops, I passed. We'll go with that after. Oh, I just did that. Okay. So now I don't know if you guys could see this, but this is sort of a comparison of John Doe, the sole proprietor, and John Doe, the PA. And let's assuming they both make $75,000, and you have that in your flyer too. But at the end of the day, the real savings here is on the self-employment tax. Also be aware that because of the chances of an audit being so much lower in a corporation, you could probably be a little more lenient when it comes to deductions. In this particular case, he's saving $2,600 being a corp versus being a sole proprietor. One of the reasons why filing a Schedule C is something that is much more highly audited than filing a S-Corp tax return is simple. The Schedule C is on a 1040. It's attached to your personal tax return. The personal tax return is a revenue-producing return for the IRS. They know if they're going to owe you money or if they're going to get money back from you. They're actually calculating tax debt. Now, if you look at an 1120S or a 1065, which is a partnership tax return, which really has no bearing on you guys, these are not revenue-producing returns for the IRS. They're strictly informational. They're called pass-throughs. So whatever the profit is on those corporations or losses, pass through to your personal. The chance of being, I mean, I've seen in 22 years, 2 S corporations have been audited, both for salary reasons. I've seen about 300 to 400 Schedule Cs audited. And you don't take my word for it. These are the actual IRS database numbers for 2015. I don't know if you could see this, but what you're going to notice here is for non-farm businesses, or where guys aren't in the business of farming, if you earn $25,000 to $200,000, that's in gross income before deductions, and you're filing a Schedule C, your likelihood of being audited is roughly 2.5%. Okay? If you're filing an S corporation, your likelihood of being audited is 0.4%. And these aren't my numbers. These are numbers that have been actually appointed, done by the IRS based on what their audits were in 2015. They're very similar to 14 and so on. Roughly 600% chance of being audited if you're on a Schedule C versus an S corp. So the bottom line, this is a win-win scenario if you do it correctly. You're going to pay less taxes, and you're going to lower your chances of being audited. Plus, when you record keep, it's going to keep yourself more organized. You're probably going to end up finding more deductions. And at the end of the day, we know that income minus expenses equals your profit. So the more expenses you have, the lower your profit, the less taxes you're going to pay. At the end of the day, as I said before, record keeping is the only way to prove your innocence in front of the IRS. Without the proper records, you're SOL. So one thing I hear all the time is record keeping is a pain. I can't track my miles. I got to create a mileage log. I can't find my receipts and whatnot. One thing I provide, and I'm not sure all the accountants do or not, is I provide an online platform where you can actually take a picture of all your receipts, upload them, and you have them at the end of the year. God forbid you're audited, they're all there. I also provide a, which you should have regardless if you work with me or someone else, you should have a overview of a log which shows all your expenses on a monthly basis so you can track them and then do a P&L at the end of the year, but you have all that information. You can follow it and throw it through. There's a mileage app, which I have no relationship with, but I use, and I encourage anybody who works for themselves to use. Yes?
Do you like MileIQ?
That's what I was about to tell you. It is MileIQ. The reason I like it, like your question, is because you don't got to worry about taking a pen out and writing, I went here and I went this many miles. It does everything for you. And then you swipe business or personal. You use it apparently, so it's a no-brainer. I mean, for what it costs, which is minimal, it's gonna save you a ton of time and a ton of headache, because that's mileage is one of the biggest audited pieces for realtors, period. So having a log that's done automatically for you, to me, it's a no-brainer. Yes?
Well, just a quick question. While
Sure.
we're on mileage, so if you lease a car, is it a different scenario versus if you own a car in terms of having to keep up mileage?
Okay, so the question is, if you lease a car, a different scenario than owning a car. The answer is the mileage is the mileage. So no matter if you're leased a car or own a car, if you drive for business, you could deduct it. On a corporation standpoint, you could also deduct your lease payments. On a Schedule C, you can't. Okay? Either way, you could depreciate it if you own your vehicle. To go into more detail, this talks about the salary, which you discussed a little bit before. I don't have to go into more details. However, just a warning, if you do not take a salary on an S Corp and they flag you, which now they're starting to look at more, they can and will reclassify your income into all salary, which defeats the whole purpose of having an S Corp in the first place. Yes?
What percentage of salary versus your gross income should the salary be?
That's a great question. There's no correct answer because the IRS purposely leaves it very loose. They say a reasonable salary. What does reasonable salary mean? What I normally do, okay, is not necessarily based on how much you're earning, although that does come into effect. Obviously, if you earn $20,000, you're not going to take a $20,000 salary. However, if you earn $150,000, I'm not going to say you have to take 60%. What I would normally do is I would look at the salary average for a realtor in the particular area you're in, which is all public, and we come to a salary that makes sense based on that, so we have something to defend. So if it's $35,000, I don't care if you make $200,000, so be it. Does that make sense? Okay. Summation, the IRS tax plan, we discussed the three acronyms: incorporate, record keeping, salary. If you do not do all three, there's no bother doing it at all, because at the end of the day, one loose piece of a stool, the whole stool's going to fall apart. We discussed the benefits, which is obviously paying less taxes, reducing your chance of an audit, becoming more organized. Okay, I mean, these are the three things that, especially as a business owner, you want. That's the end of that presentation. It's pretty quick and painless. What I really want is more of a Q&A, because I know tax is, well, A, there's tax time. B, you probably have a lot of questions about how to reduce your expenses or reduce your income. And then I'm going to give you a little tip for people who have, anybody have children between the ages of 8 and 17? Anyone? Okay. Well, for the ones you do, I'll talk to you later about giving you a little tip about how you can save more money. I'm going to open up the questions. I know this could be somewhat of a confusing topic, S Corp, Schedule C, salary, whatnot. Anything. Yes?
Do you recommend incorporating your first year since you don't really know what you're going to do in sales and commissions, and how would you pay a reasonable salary, let's say, if it's only one or two properties?
Yeah, again, I mean, there is somewhat of a break-even point. I usually say $20,000 to $25,000 in commission earned is when you want to start looking at incorporating. So if it's your first year, you haven't sold anything yet, and you're doing this, again, it's also how much time you're putting into this. If you're doing it part-time and maybe you'll make a sale here and a sale there, and is it necessary? Probably not. If you're looking at being a realtor full-time and you're putting your time into it and your goal and your expectations are to make some sales and make some money, I would certainly recommend it when you're starting out. Yeah. Yes?
Can you maybe clarify, S corp versus LLC?
Sure.
Multi-member, what we should
Sure, 100%. There's a lot of different questions about this, and there's a question that I can reiterate, it's a very, very good question because people are confused. An LLC, or a limited liability company, is a totally different structure than an S Corp. From a liability point of view, okay, we're getting off the topic of Realtor for a second and getting into a topic of maybe some of your clients who buy rental properties. You always want to put a rental property in an LLC, because it's two-way liability protection. What does that mean? If a person is on your property and falls and breaks their leg, they can't sue you personally. The S Corp provides that as well. However, if you're driving drunk one day or doing whatever you're doing and you smash somebody and you run them down and they sue you personally, they can't go after your rental property if it's in an LLC. If it's in an S Corp, they can. Okay?
single member LLC?
Okay. I hate single-member LLCs for one major reason. From a tax point of view, there's no benefit. You're back to filing on a Schedule C. The IRS views a single-member LLC as a disregarded entity. What they're pretty much saying is, great, you have an LLC and you have legal protection. From a tax point of view, there's no benefits. So my suggestion is either find another partner, me, your wife, your significant other, give them 1%, and now you're filing a 1065, which is a partnership return. We're getting it off the LLC, And what we're doing is, again, taking it away from that revenue producing tax return and bringing it to a non-revenue producing informational tax return. Because you guys don't own properties, you're not worried about people coming and falling and breaking your legs and things of that nature. I don't see a need for an LLC as a realtor. Plus, the state of Florida requires a PA in order to get paid commissions directly to you. A PA is only an S corp. So if you want to have the alternative of being a Schedule C, as a realtor, you need to be a PA, which is called a professional association, which is a type of corporation.
Tax ramifications of a supposedly trust that we were reducing taxes on, you know, different corporations. So should we go with S corp, C corp?
Okay. A C corp is a totally different structure altogether. For anyone like me or you or anyone who is not looking at a big public company, I would not recommend a C corp for a lot of reasons. There's double taxation for starters. So how a C corp works is at the tax level, the income a C corp makes is taxed. And that's what Trump's trying to reduce. Tax right now could be up to 35, 40% on a C corp. Then when the dividends are paid out, they're called dividends, are paid out to the shareholders of the C corp, they're taxed. So as an individual owner, you're going to get taxed twice. I do not recommend that. An S corp, which again, there's no taxation on an S corp. An S corp is strictly a pass-through, and that's taxed at your current personal tax bracket rate. So we're talking about the Trump, change in taxation. That's only for C corps when you're talking about business. I don't know what the structure is going to be and how he's going to change taxation. I don't think anyone does yet. I'm not sure he does. On an S corp currently, it's your personal tax rate. Whether they turn around, I know they're talking about changing it from 5 brackets to 3 tax brackets, that will affect your S corp. Is that a good, did I answer it okay? Yes? I'm sorry? A PA is can a PA only be an S corp? Yeah, PA is something called a professional association. Because what happens is you have a professional license. So in order to be incorporated as a professional, it's really called a professional service license. And professional service license is only under a PA, and a PA is only a corporation. It's not an LLC.
So it gives you the tax benefits, but not the legal benefits.
Right, but again, the legal benefits are, no one's going to sue your S corp directly. I mean, I guess if you committed fraud or whatnot. But if you committed fraud, they can pierce that corporate veil anyway. Plus, if you're holding an S corp, there's no real value. You're not holding any value because you're passing all of your income. It's not like you're holding a property that someone can now turn around and take. All the income you're getting from your S corp is actual cash money. There's no tangible. So having an LLC, there's no major benefit. Yeah.
I have a question from someone viewing. I thought you can be a single member LLC and then file a 2553 with the IRS to be taxed as an S corp.
You can be a single member LLC and file a 8832 and a 2553, which means in 8832 you're changing your entity classification from an LLC to an S corp. Okay? You're still an LLC, but you're taxed as an S corp. You can do that. However, I haven't seen many real estate brokers because the state won't allow the brokerage commission to be paid to an LLC unless it's a PA. So again, if the real estate broker allows it, have at it. Now, the other thing you can do is you can get paid to your name personally. People do that also, and transfer it to an LLC. But yes, you can open a single member LLC, and you can do an entity classification change and change it taxation structure to an S corp. I don't necessarily see much of a benefit in it, but if you want to do it, have at it.
Do you think better off having a partnership LLC in the first place and classifying it as an S corp as well?
If you have a 1065 or a partnership, yeah, I mean, again, if you want to get rid of the self-employment tax, because partnerships are subject to self-employment tax, I would definitely recategorize as an S corp,
Okay.
which is a change in entity.
And the Florida Real Estate Commission and DBPR would have no issues with the single member LLC or the other way that we refer to it.
My understanding with the Florida Real Estate Commission is that they will only allow commissions to be paid directly to a PA. So you're saying, because again, the license holder is you as an individual. An LLC doesn't own a license.
You can make your license an LLC though.
Okay, if you can, then that's, have at it. I know you can with a PA. If you can with an LLC, okay. Again, that's apparently beyond my area of realtor expertise. But again, I don't necessarily know if there's much of a benefit having a single member LLC, being that there's no properties owned. So what are they taking? Because the money's in the S corp, it's eventually passed through anyway. Questions? Yes.
So most of us right now are in the throes of doing our 2016 taxes.
Oh yeah.
Okay, so that being said, is it too late to set up a PA for 2016? Or
Yeah, 16 has passed.
done? Okay, yeah.
16 is in the past. So we can also have a PA, even though it's, we're getting into March right now, we're in March. It'll still be good for the whole year of 2017. That's not a problem. We can't go back a year though.
And what's involved monetarily as it relates to setting up a PA?
Setting up a PA, again, is A, you're going to have to register the name of the corporation, which would be your name, comma, PA. You would have to go to DVPR and tell them, or is it DVPR? And telling them, okay, I'm professional service license and I'm putting my real estate license with my PA. And then obviously we have to apply for an EIN number or a tax ID number from the IRS. And then lastly, we have to fill something called a 2553 form. And that says, I don't want to be a C Corp, I want to be a subchapter S corporation. So those are all the steps that have to take place.
And then you have to submit a new W-9 to your office.
Right, the W-9 to your office, which in theory, I mean, I don't know how you guys do it, but in theory, according to the IRS law, you do not have to issue a 1099 to a corp. You do to an LLC, you do to an individual, you do not have to do to a corp. Yeah.
150 a year.
No, regardless of the amount. Under 600, no one has to get 1099. Above 600, everybody does except for a corporation. Corporations are exempt.
So if someone's an LLC or a PA,
If they're,
being filed as an S corp, they don't need a 1099?
no. They do not need to receive a 1099. You can give it to them, but you don't have to.
With an S corp, we're saying there's no liability protection?
There is, but only on the corporation side. So in other words, if someone sues your corporation, they can't go after you personally. That's the liability protection you want. However, if someone sues you as an individual, okay, they can still go after your S corp. But what the argument is, there's nothing being held of value in the S corp. The reason you have an LLC structure is if you hold something as tangible of value, like a real estate property or a piece of equipment or something like that. In that particular case, you don't want them to have access to it. Most real estate professionals aren't, going to put a rental property inside their PA. You don't do that. That's a separate LLC.
So LLC versus PA, benefit of one over the other, as for a realtor.
Okay. For a realtor, again, I don't see a benefit of an LLC. It does provide you the two-sided protection. So if someone sues you as an individual, nothing to do with your LLC, they can't go after your LLC. But what does that mean? To go after your LLC, there has to be monies of value that aren't attached to you personally. So for example, any income, because it's a flow-through, whether it's an LLC attached to, if it's an LLC or a S corp, because it's a flow-through, the money is considered yours as an individual regardless. The only things that cannot be touched would be things that are housed in the LLC, like a piece of rental property, like a boat, something that is tangible that they can grab. So if you have clients that are looking to do rental properties, things of that nature, do not put it in S corp, put it in LLC. If you're doing a service business where you have no tangible goods, an S corp is fine. Does that make sense? Yes.
What are the tax savings and tax consequences of setting this all up?
That's a great question. And we can go back to that form somehow, and I'll go over details with you. A lot of it is you have a lot more leeway or a little more wiggle room when it comes to deductions on an S corp. Okay. Most importantly, again, it comes into that reasonable salary world. So John Doe, the sole proprietor, let's say he makes $75,000. And John Doe, the PA, same guy, makes $75,000. They both have $25,000 in deductions. I would assume normally the PA would have a little bit more. But we're playing it as even, okay? Let's assume we say based on 75,000 minus 25,000, he has $50,000 in income. And let's say we look at it and we see the average is $20,000 for salary, which I think is fair. $20,000 salary expense would leave 28, let me see here, would leave $28,000 in profit, okay? Because you're taking 75 minus 25 is 50, minus the 20, 50, minus the 20 is 30, minus the deduction for the payroll taxes, because you're paying 15 payroll tax. And that would equate to a profit of roughly $28,470 versus here, self-employment tax is significantly higher. You're paying $76.50 here in self-employment tax
So,
on 50 grand.
but in addition, John Doe PA is also paying a personal tax as well. right?
Well, again,
Filing an
John Doe PA doesn't pay any tax. The PA doesn't pay any tax. So we're assuming this is a pass-through. At the end of the day, his income, and I have to walk you through this because it's a little, there's a lot of moving parts, but both of these are taxed at the personal level. There is no tax on the PA at all. Okay, remember I said this is not a revenue-producing tax return. So it's strictly informational. What's happening is the taxes that are being paid by John Doe are going to be the income tax, which I'm assuming 20%. You probably can't see that. Okay? 20% on the income. So if we look at this and we say, okay, his income after his expenses is $50,000 as a PA. He has to pay 15.3% in self-employment tax on that $50,000, which is $76.50. Okay? He gets a deduction of $3,800. You can't really see it. You get half of the self-employment tax as a deduction. So we take this $50,000 minus that number, $3,000, and we multiply that by the 20% income tax. And his income after taxes is $33,115. You following me? Because I know there's a lot of numbers here. But 15.6% is the number you have to realize. 15.6% of 50 grand. Then 20%, if he's in the 20% bracket, 20% we're using as a sort of fictitious number. But 20% on the profits, 50,000 minus that deduction for the half of the self-employment tax leaves you 20% tax would be 9,233, I believe. I can't really see it, but okay. And your income after taxes is 33,115. Now we have John Doe PA.
So what you're saying in the sole proprietor column, that person, John Doe, sole proprietor, paid $92.35 in taxes.
$92.35 in income tax.
Okay.
Another $76.50 in self-employment tax.
So they paid essentially
$16,000. Okay? On $75,000 of income, $25,000 deductions, they're putting out of their pocket $16,000 in tax. John Doe PA is going to pay the 15.3% on that 20 grand, which is roughly 3,000 and change. You can't really see 3,080 maybe. So 3,080 versus the 7650. Okay. Now we take this $20,000 plus the 28 is $48,000 that he's paying tax on. He's roughly paying $9,600 versus $9,235 in income tax. So if I take this $9,600 plus 15% of this of 20,000, which is 3, you're looking at about what, 12,600 versus the 15, 16.
So
That's the difference. Well, we have a lot more flexibility with the, because self-employment tax is 15.3% on all of your earnings, everything.
So,
Go ahead.
column number 1, column number 2 is like 16, he pays on the first one and 12,000 on the second.
Again, it's sort of loose because there are deductions for the self-employment tax, half of the self-employment tax, and the payroll tax. It ends up being, in this particular case, about a $2,600 savings because you're paying a lot less than self-employment tax. That's where the savings is coming from, about $2,600. Those, either way, are both paid through the personal tax return.
as far as setting up the actual salary itself, you have to physically pay yourself every month.
Great question. A lot of my clients come to me and say, I don't want to pull my money out of my business. The IRS does not care if you take the money, literally take the money out or not. You can pay yourself a salary, and as long as you pay the payroll tax, and you decide, well, I would have reinvested it back in the company anyway, you can leave it in the company. I don't care if you write a payroll check to yourself, as long as the tax is paid.
The payroll tax has to be done quarterly.
Payroll tax has to be filed quarterly, depending on how much money you make. If you're making a lot of money, maybe filed monthly, but normally it's quarterly, and it's on something called a 941. Which, I'm sorry?
What is a lot of money?
If you're paying more than $5,000, well, if you're paying more than $2,600, give or take, in a quarter, they want you to start paying monthly. But that means you're putting $10,000 in payroll tax, which means you're taking a salary of roughly 120 grand or so, which I can't see most realtors doing. So normally you'd be paying it quarterly, because there's no reason to take a salary that big. So you're paying it quarterly, you're filing a 941, and you're sending the payroll tax quarterly to the IRS. That's sort of how it works. Any?
Typically, every 50,000, you might see about 2,500, or 100,000, you might see about 5,000.
Again, these are a loose example, because if I'm sitting down with you and I'm looking at your various expenses, you have a little more leeway on an S corp than you would on a Schedule C.
You were touching on leasing, like you was asking about leasing cars you buy. With leasing, I mean, it does says, we're going to go and buy a new car soon. Should we lease rather than buy?
That depends on how many miles you drive. I mean, that depends on how many miles you drive. I mean, at the end of the day, if you're driving more than the lease amount, then I would totally recommend against that.
Well, let's say you're driving an average amount right now.
You know, it's a personal preference. Either way, you're going to depreciate the vehicle, or you're going to take the lease payments off.
Or you know what?
On the Schedule C, taking the lease payments off is frowned upon. On an S corporation, it's expected.
So in S corp, you can write off the lease payments.
I do it all the time.
As an individual, can you write off the
No, you're really looking at mileage. Whereas on an S corp, you can do mileage and the lease payment.
You're saying these payments are not deductible as an individual?
Either or, either the mileage, or they figure out, you know, because we do a Schedule C at the file, something called 2106. 2106 works is you're putting your lease payments in, your repairs in, your gas in, and then you put your mileage in, and you get the difference. What's higher?
Seems to me that's about 20% the difference that you end up saving. The thing is what you put on the payroll tax, so how do you get to the payroll tax?
Okay, the payroll tax number is, again, you're back to that 15.3%, but it's 15.3% on your salary versus 15.3% on your whole profit. That's the big difference. So if your profit is $50,000, 15.3% on the $50,000 is $7,500, give or take, $7,600. 15.3% on $20,000 is roughly $3,000. And then, of course, there's our other deductions for self-employment tax versus payroll tax, but that's how it works out. Yeah.
Can you talk about what we can use as tax write-offs as realtors?
Yeah, it's a good question. I actually have a tax, I probably should have brought it. I have a tax form, and maybe I'll bring it up and I'll show you guys, but which pretty much you look at there, it's a guide, and it has all the various different expenses that you can write off.
Can you send that to us?
Absolutely. In fact, I will email it here and have it distributed. What it really is, and it's a week guide, okay? But it has almost like a spreadsheet where you may have 50 different items, 50 different line items. Everything from meals and entertainment to gifts to realtor dues to home office expense, which is a big one.
That's a question that I have.
Yes.
If we work out of our home, and part of our home is our office, and our office is strictly an office, can that be a write-off for us?
100%. Absolutely.
Is that looked at by the IRS as something that they want to target?
Yeah, we've had this conversation before. At the end of the day, the home office expense is there for a reason, because it's something that you can take. I can't tell you exactly when they look at a Schedule C if they're being flagged because of mileage, if it's being flagged because of home office expense. I know the Schedule C is a much higher audited form. If you fill out the home office worksheet on the tax return, and it's reasonable, they shouldn't give you a problem. Obviously, if you're saying that 40% of your house is your office, unless you live in New York City and you have a 500 square foot apartment, I have a hard time believing that. So that might give you an issue. Yes.
Question for you.
Mm-hmm.
If you pay yourself a salary
Yes.
and you're paying taxes on that, and let's say you want to put it back into your business,
Mhm.
can you place that back into your business as a loan to your business?
Can you paste it back? Okay. Well, at the end of the day, there's two ways of looking at this. You have to understand something. Right now, we're talking about self-employment tax. Self-employment tax, when I say 15.3%, let me explain how they get to that number. Self-employment tax is something called FICA. You ever guys heard of FICA before? Okay. FICA tax is half paid by an employee and half paid by an employer. Now, if you're a regular W-2 employee working at a company, the employer pays 7.65%. That's 6.2% for Social Security and 1.45% for Medicare. If you're self-employed, which everyone is here, you're the employee and the employer. So you're taking that 7.65% for the employee, and you being the employer are paying that 7.65% as well. So that 15.3% that you're sending to the government, okay, is money that's coming out of your account regardless. The $20,000, okay, on that salary, understand that, you're getting a W-2. So whether you put it in the company or not, it's going to be taxed. You're a salaried employee. You're getting a W-2 for $20,000. That $20,000 is going to show up on line 7 of your 1040. Just like if you work for a company and they give you a $20,000 W-2. So what's happening is he's going to get a $20,000 W-2 and a $28,000 K-1. A K-1 is a pass-through showing the profits from the business. This guy is going to file a Schedule C, and he's going to show $50,000 on the Schedule C. That $50,000 is taxed differently. You can take the 15.3% out, and the $50,000 is fully subject to federal income tax. So whether you take it out of the business or not, it's going to be taxed regardless. The $20,000 is going to be shown as a W-2. It's going to show as Social Security payments. If you want to withhold federal tax in your W-2, we do that all the time. You can do that as well, which will hopefully lessen the burden of how much you would owe in the end. Yes?
So let's say for sake of argument, you claim $20,000 as a salary expense, but at the end of the year, you make, I don't know, $150,000. Do you have to play catch-up, or do you?
Yeah, what happened is, and this is where your accountant really comes into play. I do with hundreds of realtors who are clients of mine. And normally what they'll do is they'll call me up when they sell a house. Because again, you don't have this even amount of money you're making every week or every month. So every month or every month and a half, they're going to touch with me and say, hey, Dave, I sold a house. I made $8,000 commission. And I'll say, okay, great. Let's take $2,000 salary and pay it off. And now we know that portion's paid. So our goal is to make sure that we're increasing your salary as you're making income. Because if we take $20,000 for the year and you're showing $150,000 in income, it's going to be a problem. So you need to be in touch with your accountant throughout the year, explaining that I made this amount of money, I want to increase my salary, or I'm going to tell you we should increase your salary. Because otherwise, it's going to look like this is not really reasonable. So we're going to go, it has to be custom for you, not one person's the same.
And then when you say you take a salary, are you actually receiving a check? Or
That's up to you.
Is the most important thing the fact that you pay those taxes?
Right, you're paying the payroll tax. So the government is happy knowing that, okay, you're paying us as if you took a $20,000 salary. You paid the tax on that responsibility. Now, if you took the $20,000, the rest of the remaining, let's say it's $20,000 minus 15.3%, let's say for argument's sake it's $17,000, $16,000 left. If you took $16,000 and you wrote a check to your name and deposited in your personal account, that's fine. If instead you said, I'm going to leave it in the company, that's fine too. There's no ifs, ands, or buts, it doesn't matter. As long as they get their payment, you don't have to take it out. You can if you want to. At the end of the day, remember, S Corporation pays pays taxes on all the profits, whether they're pulled out or not. There is no retained earnings. Retained earnings is a C Corp word, which talks about we're keeping X amount of dollars, we're not distributing dividends. It doesn't work that way for an S Corp.
And then monetarily, what's involved in setting, like what expenses would we as an agent have to you to set up an S
Okay.
corp?
Normally what I do is I charge $350 for the setup. That includes obviously incorporating the PA, getting your EIN number, and filing your 2553, getting everything set up, telling you, okay, bring this to the DBPR, get licensed, go. That's turnkey. From there, we become friends because I'm going to be in touch with you a lot, okay, at least quarterly. And at that point, because quarterly, we're going to file something called a 941. A 941 is a payroll tax return. Even if you take zero, let's say for the first January, February, March, you make 0 sales. We still have to file a tax return. And we get show 0, we have to file it, okay? If you don't file it, the IRS gets grumpy. So we file a 0 tax return. The next quarter, you do $30,000 in commissions. We take, let's say, $8,000 in the salary. We file a payroll tax return. Same thing happens, so forth, so on. At the end of the year, all your payroll tax returns are done, and we make a W-2 for you. That W-2 is based on the salary that you're taking for the year. Why am I sitting against the wall? Is taking the all the salary that you take for the year on the 941 is now given to you on a W-2. So what happens is, I made $100,000. I took a $30,000 salary. So what happens? We take the $100,000. We knock off the $30,000. The $30,000 is an expense to your corporation. Okay? So now you're showing $70,000 in profit. Then we take all your other expenses. Realtor dues, your driving, your car, your home office, your supplies, your marketing. There's a million things which I'll give you guys. After that, so the $30,000 comes off, all the other expenses come off, half of the payroll taxes come off, because that's the employee side, the employer side, and what you're left with is a profit or a loss, depending on what happens, how much expenses you have. That profit is issued on something called a K-1. A K-1 is issued by an LLC, which is a multi-member, which files a partnership tax return, or an S corporation, and that K-1 is now reported, that's informational, which is reported onto your personal tax return on line 17, if that matters to you. So let's say your profit is $26,000. That $26,000 is shown as income on your personal tax return from your corporation. Your W-2 is also shown as income on line 7 from your corporation. So maybe you're showing let's say you're showing $30,000 in W-2 income, $25,000 in profit. They're two different lines. And now that's $55,000. Let's say you're following a Schedule C instead, you're probably going to show $65,000 in your Schedule C on line 12 versus the line 7 and line 17. Yes?
You spoke about setting up the LLC or PA,
Mhm.
doing the EIN, that turnkey. How about the quarterly filings costed? If
Okay.
working with your company,
Yes.
working with you, cost on the quarterly filings and annual filings as well.
Okay. Let me explain what goes into a corporation, because it's not a wham bam thank you ma'am thing. There's a lot of moving parts.
Seems like an ongoing relationship.
It's an ongoing relationship, and I do this. You have to like me. If you don't like me, I'm not the person for you. But let me explain what I do, okay? And just so you understand what goes in, because my goal is to make it as easy and as not overwhelming for you. I handle everything. We just talk. I give you ideas. You say no, yeah. I don't want to take a salary this much. This, I have this expense. Yada yada yada. And we come to my goal is to keep you out of trouble. Your goal is to keep as much money as you can. My goal is to help you keep as much money as you can with not getting problems. Every quarter, maybe more often depending on your sales, we're going to come to a salary, and I'm going to sit down and file these 941s for you. I'm going to file something called an RT6 for you. An RT6 is self-employment tax, because Florida wants to cut too. Now the most you're going to pay in self-employment tax for the year is $189 currently. Will that rate change? Who knows? And the benefit of that is, this is interesting, is that you're filing unemployment tax. So if you lay yourself off, or you close your business, well, we're going to lay yourself off, you can collect unemployment. We won't get into that now. So you're paying $189 for self-employment tax a year, tops. And that's if you make $7,000 or more in salary. Now, you're also filing something called a FUTA tax. Federal unemployment tax, that's $42 a year, tops. But you got to file it. That's called the 940. That's federal as well. Then there's a W-2. A W-2 is issued to you, which shows your salary, which is sent to Social Security, so you get credit if Social Security is still there 20 years from now. Then you got to file something called a W-3, which is the total of all your employees. We do all this. You do nothing. Lastly, we file something called an 1120S if you're a PA. Well, either way, you're going to file 1120S, unless you have a two-man team, you're doing a partnership, it would be 1065. And then we file your personal tax return. So there's a lot of work that goes into it. I charge anywhere from $850 to $1,000 per year for everything, for all the ongoing. That's both tax returns, personal, the corp, all 4 payroll tax filings, all 4 RT6 filings, the 940, the W-2, W-3. Depending on how often, like if I'm speaking to you every 2 weeks, every 3 weeks, probably close to $1,000 a year. If I'm speaking to you once a quarter, probably $850, $900, something like that.
That includes the setting up the PA?
No, the PA, that's separate. That's a one-time fee.
Now, does that include spouses, taxes as well?
If you're filing jointly, that's fine. I throw that in there. I mean, your personal tax return is included. And unless you come to me and say, oh, by the way, I have 15 rental properties here, and I have 4 of the corporations, and then obviously we're talking about a whole different beast.
Suppose I did have few properties, how would
Again, I'd have to look at your tax return. The more complex of a tax return, because now your personal tax return is becoming more of a business. Because now you have the Schedule E, and if you have 3 different properties, there's a lot of different forms to file. I'd have to look at your individual situation. Yes?
You already have commissions paid this year. Is it retroactive? You already have to-
Yes. So in other words, in 2017, you open up a PA, okay, your business. Even if you're issued a 1099 for you personally, for the monies you received so far, we're going to zero that 1099 out on your Schedule C, paid to your PA, and we're going to claim everything on your PA. That's fine.
I heard that it was, it's not retroactive, commissions, would be after.
Well, retroactive in the fact that they can't turn around and reissue the commissions to you. There's no one to say that you couldn't take those commissions, in theory, and put them into your PA. So in essence, what you're doing is you're saying, well, I'm taking my money, I'm putting it into my PA. And now it's wiped right off. As long as you're claiming the income, the IRS doesn't care. The key is do not claim the income. That's when you get silver handcuffs.
If you establish yourself as an LLC or a PA, change your license and get a new W-9 to us, we can change your account in our accounting system, so at the end of the year, you're being 1099 to your PA or your LLC.
Right, and if they're willing to do that, that's even better. Yes? Okay, the annual report is a Florida way of extorting you. Unfortunately, there's no ifs, ands, buts around it. An annual report is to keep your company open. You pay it every year. I can do it for you. You can do it yourself. I don't make any money on it. I just.
You included the 50, that's awesome.
I know. It's $150. Well, for LLC, I think it's 130 something. For a corporate thing, 150. And all it really is going on to Sunbiz and clicking that nothing's changed. You didn't change your address. You didn't change your name if you got married or whatever. And you hit OK. You give them a credit card, and you're done. So it's their way of, hey, we don't charge state income tax. We're going to make it somewhere.
What's the deadlines for PA for 2017? And then you can retroactive.
There's really no deadlines because, I mean, in theory for you guys, because you're already operating, the sooner the better. Obviously, if you came to me and you said, I want to start a business in October, and you're just starting it, you just start it. Because you guys are operating, I mean, I'd rather not open a PA in November and then say, let's move everything over when you're being paid for the past 10 months. You follow what I'm saying? So the earlier the better.
But could you do that if you want to start a PA in September? You want to see any commissions on the
Well, especially if you're dealing with like a broker that is willing to issue the commissions to your PA, and they're not going to give you a 1099, have at it. Again, if it's nothing outlandishly crazy where we're showing $100,000 1099, which we had to move over because you opened up, your PA in December 1st, they're going to be like, yeah, right. The IRS is going to be like, no, something ain't kosher. Does that make sense? Anything? Yes.
For a realtor owning rental rental properties, what would you, let's say one or two to start with, would you recommend incorporating yourself separately from, let's say, an LLC for the?
Yes, 100%, because now you're dealing with property. Now you're dealing with something where you want the double protection. Because now someone could attach that property and say, I'm suing you, and I want to be a part owner of your property now, a partner of yours. That you don't want. So what I would do is open up an LLC for the property. Preferably each property should have its own LLC. Because if you own 3 properties and one person breaks his leg on one of them and they're all in the LLC, they can go after all 3 of them. So you want to protect them. Make sure that whoever works with you knows you're in the business of real estate. Because 99% of tax returns on a schedule or done on a Schedule E, not a Schedule E, excuse me, 99% of tax returns on rental property are done as passive. Okay? You have the benefit, because you're in the business of real estate, if you rent the property, that can be an actively managed part of your business. Because you can say, I'm in the business of real estate. The IRS needs to see your license, and you're good to go. What does that mean? It means a lot. If I own 3 different properties, and I have a loss of $60,000 because I'm depreciating them, which is a very wise thing to do, I can only take $25,000 of losses. Even worse, if I hit AMT, which makes you're earning $250,000 more, you may not get any depreciation. You may be able to carry any of the losses passed through. If it's actively managed, whatever the losses are, you pass them through. It doesn't make a difference. There's no limit. So it's very, very beneficial to make sure that it's done actively, not passively.
Another question, thanks to this one, I'm not sure if you're the right person to ask, but many times obviously you take the rental property with financing.
Sure.
Transferring it to your LLC or opening an LLC for this particular property, how would that be looked at from the financing institution?
Okay. So let's repeat the question so I make sure I'm aware of what you're saying. My understanding is that I open up a property, I finance it in my own name. Okay? The property is held in whose name? Your own name?
My own name.
Okay. This is an issue more of acceleration as opposed to tax.
That's why I wasn't sure.
So this is more of a legal question, because what I don't want to tell you is, oh, don't worry about it, put it in the LLC's name, because what may happen, not that I've ever seen it happen, but legally it could, is they could turn around and say, oh, you transferred the property, and now we're going to accelerate your mortgage. Normally I haven't seen that happen, but I have a good attorney if you need one who's a real estate attorney who deals with that.
But would there be, okay, there might be a due on sale clause, it really depends on the bank.
Yeah, that's
The
a,
bank, I might say, I don't mind as long as you pay the mortgage, depends on the bank.
right.
But is there a IRS consequence of them transferring that property to an LLC?
No, not at all.
Is there be considered a sale there?
No, it's a like exchange, equal value.
So we just do a quick claim for $10?
Just doing, yeah, just transfer. That's fine. But again, the acceleration and stuff, I would definitely want to protect myself from the mortgage company. And again, maybe you tell the bank up front, I'm going to own this in LLC. They may give you no problem. I don't know. Anything else?
Where are you located? You were in the physical office, rather.
Okay, I have an office in Lake Worth. From time to time, I do come south. Some come south. So I have clients in Pompano. I share an office in Coral Springs, which is not too far from here. And I have an office in New York, which probably doesn't help you. So I'm not just the Florida tax guy. Yes.
If you're looking to buy or lease a new vehicle, I heard if the GVW is over 6,000,
Ah, yes.
you would get a much better tax deduction.
Okay. If the GVWR, let me explain what that is. That's the gross vehicle weight rating. So that's the size of the vehicle, which really only equates to certain types of vehicles. Chevy Tahoe, a Suburban, maybe a Cadillac Escalade, something along those lines. Big boys. The IRS gives you something called the ability to do a Section 187 deduction. What does that mean? It means you can depreciate a lot more of the vehicle up front. So, which can be really beneficial. Let's say you have a killer year and you make $300,000 in commission, and you want to reduce that expense. That's certainly a way to go.
Go buy an Escalade.
Go buy your, Lincoln Navigator or whatever your, 6,000 GVWR. How they came up with that number, I can't tell you.
Well, it's the difference between a personal vehicle and a more
Right,
commercial
but let's say you have a Pathfinder that's 5,300 pounds. Sorry, doesn't qualify. I don't know how they came with the 6. Like a Tahoe qualifies, but that doesn't. I don't know where the line.
Cargo vans, work trucks, most of them just hit over 6,000.
Right, which very well could be.
Whether it's PA or individual, is that come into play at all?
No, the depreciation is depreciation. So depreciation,
It's gonna be used, it's gonna be new vehicles, it's gonna be used vehicle.
not going to be used. What you can't do, this is very important, you can't buy it in 15, not do anything, and then say in 17, ha-ha, now I got money I'm depreciating. It doesn't work that way. They will rat you out.
Are there any benefits for the other regular size cars and SUVs and electric?
Regular sized cars depreciate over 5 years. Electric vehicles are different. They have a tax credit. So if you go out and buy a Tesla, we could talk. You're going to get $3,500 back in cash.
What about if you lease one of those electric? You have to purchase it.
The electric cars have a threshold of 200,000 units sold by each model of manufacturer.
I know that. I don't know about that. I could tell you that, like Tesla, I think the Chevy Volt maybe. There's a few different cars that fall under this Fisker. I don't know if you're buying one of those anymore, but a Prius is different because that's called a hybrid. The purely electric with no gas at all is. I guess if you're in the golf business, you have a shot. I don't know. Well, in theory, if you're driving around the golfing communities, we can take off the mileage, and you can depreciate the golf cart. I'm not sure how much that's worth, but that's true. It is purely electric. No, they don't look at it that way. It's got to be an on-road vehicle.
So
Yeah.
to clarify, 6,000 GVW is gonna be purchased on lease?
Cannot be a lease because you can't depreciate a lease because you don't own it. Yes.
And if you do lease a car, the write-off that you're allowed is either the mileage, in which case you have to keep track of it, or you can just simply deduct the lease payment.
I wouldn't do that on a Schedule C.
What do you mean you wouldn't do what?
I wouldn't take the lease payment and the mileage. You're gonna get flagged.
Either, I'm saying you're safe to take either or.
Yeah, what happens is you're gonna fill out something called 2106 if you do a Schedule C, and you're not incorporated. Okay, you're gonna file something called a 2106, which is you're showing your vehicle information. It's gonna ask the type of vehicle you have, how many miles you drove for the year, how many miles were business, how much mile was commuting. For commuting, you guys is really zero because you're self-employed. You're not going back and forth to one particular place, especially if you have a home office. And then it's going to do, okay, we're going to calculate that, the miles, 57.5%. Then they're going to ask you what your actual expenses are. And that's your gas, that's your lease payments, that's your repairs. And they're going to do a percentage of that. Whichever one's higher is the one you get.
Would you feel it is more beneficial, let's say you are incorporated
Mhm.
under a PA or a partnership LLC, either one. Is it more beneficial, do you have more tax benefits buying the car or leasing the car?
Normally, again, when I deal with corps, I've done this a million times, I will take off the lease and I'll take off auto expense as well on a corp, not on a Schedule C. Leasing or depreciating, it's really a matter of, I guess, how good of a deal you get. I mean, that's more of a personal feel.
And half dozen the other.
Yeah,
deal?
yeah. It just depends how good of a deal you're getting.
And if purchasing or leasing and you're incorporated, put it under your PA or
No.
LLC or good personal?
Good personal. The fact is that you're lending your car out to your PA when you're driving it for work.
Nothing additional you have to do to set that up?
No. But do that Mile IQ. Do that swiping. You guys, have you seen it before? I'm going to show it to you? Okay. So let's give this a look. And just let you know, I'm not an owner or have anything to do with Mile IQ.
He does get kickbacks.
I don't get kickbacks. I wish I did. Although I can get you guys better deals because I'm an accountant, because they want my referrals. And I just like the app because I would much rather have someone come to me and have this than someone come to me and goes, I don't know, I probably did like 18,000 miles. And God forbid you get audited. I mean, look, I'll work with you. I mean, at the end of the day, you're the person who's coming to me with the information. But God forbid you ever audited and they say, oh, okay, prove where you went. You're going to get a call from me. I'm like, okay, it's time to create a mileage log. And you're going to hate doing it because you remember 3 years back, well, I think I went here and then I went there and then I go to MapQuest and print all these things out. It's a nightmare. I've been through it. You do not want to do it. It's just so simple.